Is for putting money into equities?
In equities, if you ask me, there are three things which matter: whether there's fear, how's the valuation, and third is what is the flows. So, for example, whenever FIs sell, you have to put money in equities. So,
because fear is rising?
Yeah, fear is rising. In fact, we looked at the last 20 years and found that whenever FIs have sold aggressively, like 1998, 2002, 2008, 2011, and recently in August, September 2015, those five are opportunities to invest. But if you didn't have a checklist, you'd be wondering what would happen tomorrow, because every day you're worried what's happening in China, what's happening in emerging markets. But actually a checklist gives us the confidence to say this time to put money today.
If checklist was all there was to your investment process, a database specialist would be a great stock picker. But clearly that's not true.
That's why even if you make use of checklist, doesn't ensure complete elimination of mistakes. This is not like in the airline industry, whereas you can't have any accidents. Here you do make mistakes because markets behave differently, people in the markets behave differently. So it only reduces the number of mistakes. But once you reduce the number of mistakes, you are on a good wicket in the market over a long period of time.
You actually met Atul Gawande, right? What did he explain to you about the checklist process?
So he actually, is a medical doctor,
yes,
and it was a medical doctor. He was telling us how beautifully using checklist reduce the number of mistakes in the operation theater. And he found a lot of people like Monish Pabrai and others who used this checklist, what he wrote about medicine, into investing. And then he finally wrote the book.
Give me an example in life where in your career a checklist has actually helped you.
Clearly, if you ask me, you can see a bubble. For example, if you look at a situation of fear, take metals for example in August, September, in 2015.
Right.
If you look at it at that point of time, the key characteristic is fear. You have a company called Glencore, which is listed in London.
Down 90%.
Down 90%.
Right.
And then you go and look at the company. It's led by smart people.
Has cash.
Has cash. It has been not the worst company in the world. So you look at that day, you can clearly see that it was what I call almost like a lemon moment in metals. So on that day, for you to gather the guts to look at metals as a sector and tell the external world that metals looks like a good pick was such a difficult thing. And I couldn't believe in the 15 days which followed that day, certain metal stocks in India gave 40% returns.
The team of friends were a group of fellow investors in Chennai, right?
Yes.
That influenced you a lot. Just tell me a little bit about that.
Yeah, actually that group, were all people who needed, in those days I would call psychiatric help, because all of us had lost money in the 94 to 97 period.
Right.
So we all needed support to know what mistake we made.
And looking for answers.
So we got into this group. When we entered this group and then went about the process, we realized that you can't be a momentum investor in the long run to make money. You need to know when to buy and you need to know when to sell. And most of the time when you want to sell, the others should be interested in buying and you should be interested in not buying. So that's how the whole concept of, I would say, contrarian thinking came. And for which our first experience was 99-2000.
The tech bubble.
The tech bubble, when we saw stocks like Global Tele, DSQ Software, Pentamedia. Pentamedia was a Chennai
stratospheric heights.
Yeah, and
they were the most celebrated stocks.
And we had to avoid them. And most people around us said, these people have more than 10 years experience in equities and they're saying these companies are useless. We are making money. But contrarian investing said that we have to look at the stock and come to a conclusion. We were negative on many of them.
Right.
So contrarian investing helped us to stay solvent. First, we were considered irrational in 99-2000.
You didn't get it.
We didn't get it. And then we realized that we were solvent when the others became insolvent in 2001.
When you do contrarian investing, it's not just about being different from the crowd. You want to find triggers for a change, right? So how do you assess the triggers in a sector that you like?
But sometimes the triggers in 2007, frankly, we never knew that there was a global financial crisis coming. And towards the end of 2007, as the markets kept going up, we didn't know what that trigger would be. What our 99-2000 had definitely told me that something will happen.
The end is nigh.
When will it happen? I don't know. But 99 2000 told me that it will happen. And you won't know the reason. And
you look for anecdotal evidence that the public starts coming into the market, people talk nonsense. Is that some of the checklists of a bear market?
Clearly of a big bull market. In that period, I had analysts coming into my room and telling me the stock looks very cheap on 2014 earnings.
In 2008? That triggers a bell.
That clearly triggered a bell. And market caps. In that period, there were market caps which were astounding. If you look at some of the companies then, like some of the real estate companies was higher than the entire pharma sector.
Correct.
So my contrarian...
A power company was more than the entire FMCG basket, I remember. Yeah.
So those market caps don't lie. You know, earnings can go up cyclically, can come down cyclically. But market caps gave me the best reasons to stay rational. But it was tough.
Give me an example of something that, a value trap that you avoided. How about the PSU banks, which were the favored sector in the market, but you avoided them?
In 2008, you know, due to what happened in the global financial crisis, money went to public banks all over the world.
Correct.
So that was a very interesting period where what you saw that in a sector where both private sector and public sector is there, the public sector gained in the year 2008 across the world.
Because there were sovereign guarantees there.
There were sovereign guarantees. So people got into this perception that, you know, what was true in other sectors where private sector gains would not happen in banking. So it was, whereas you looked at the entire process, you knew that was a one-time event out of GFC.
Your checklist told you that problems ahead in the credit cycle.
Yes. And that's why from then on, you know, it was pretty easy to know that private banks would gain at the expense of public sector banks. And actually it also proved, 2008 proved that banking was a more unsafe sector from an equity investor point of view, and you had to do your rigorous work than any other sector, because one of the persons whom I used to watch, the Legg Mason Value Fund of Bill Miller. His fund got destroyed in 2008.
He just got a whole bunch of wrong stocks.
Yeah, because he had 38% weightage in financials. That combination, I realized that you have to be very careful in leverage sectors.
That's after 20 years of outperforming the S&P continuously almost. The man went overweight and got a divorce. That's what I heard. But you have a reputation in the industry of not being afraid to trade your stocks.
Yes, sometimes you do it, but like for example in 2012-13, for almost 2 years now I've been underweight some of the quality stocks, and quality stocks have continued to do well. But what I find is with this whole world of passive investing which has come in the rest of the world, there are opportunities which come due to, you know, induction of stocks into some index, dropping of stocks from index, and those give me very good arbitrage opportunity.
But other than your famous checklist and the famous contrarianism, what else do you look at? I mean, you often say that current account deficit is something you pay a lot of importance to.
Yeah, I do pay importance to many factors, and I believe that, you know, if you see capital being allocated well in a country or in a company, you tend to make money. So, you know, you always look at how capital is allocated, and if you feel capital is allocated well, you tend to make money. And that's true of a country also. If you see why India is one of the better equity opportunities, is because as a country, we have allocated capital much better than some of the other countries which may have grown faster but have not allocated capital.
Okay, at least that's a kind word. Well, you can watch this entire very absorbing conversation with S. Naren on Wizards of Dalal Street at these times that will come up for you on CNBC TV 18. That's another Wizard of Dalal Street for you. Well, Indiabulls numbers are flashing by. It looks like a very good bottom line number.